Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, aka Mr. Valuation. As a value investor, I think it's really important to understand just how important valuation is regarding making sound, long-term, and profitable and successful investment decisions. A lot of people don't understand that. Most people tend to be price-focused. Now, there's an acronym that I like called EDMP. That stands for Earnings Determine Market Price in the long run. But there's also a short run acronym, EDMP, and that's Emotions Determine Market Price in the short run. And that can be fear or greed primarily. But the point is, another thing that people, I think, fail to consider is that markets often misappraise stocks. They often will way overvalue a stock, and they often will way undervalue a stock. And by the way, they very often value it just right, because the idea of value investing is to invest in the business when you're buying it where the value of the fundamentals, the earnings and cash flows and dividends justify the price you're paying and also allow you to participate in the growth of the business. So what I've got here, I've got a tale of two companies I'm going to do in today's video. I'm going to look at Target and I'm going to look at Walmart. Obviously, two companies in very similar industries. And as you'll see as I go through the video, companies with very similar fundamental results, but you're going to find that they have extremely different valuations currently. And the question is why? Well, oftentimes it's just because of the short-term EDMP, emotions determine market price. People get excited or people get frightened, and they can run stock prices to stratospheric levels, and they can also run them to unbelievably undervaluation levels. One of the very best benefits of Fast Graphs, it's an analytical tool that allows you to recognize those anomalies when they occur, and therefore you can make judgments. So we're going to analyze Target versus Walmart in today's video. So let's go ahead and get into the Fast Graphs and look at these two companies. First, the similarities. So I'm going to start here with a graph on Walmart. Now, what I want you to do is understand what you're looking at here, of those of you who are familiar with the tool. This orange line is a plotting of earnings. And as you can see, Walmart has grown earnings at 6.3%. That's earnings growing from this point to this point, which includes some estimate data. Okay? So you can see it's been a pretty consistent grower. They have had some years where earnings have dropped, but they've averaged about 6% growth. Now let's look at Target, and let's look at Target from the same aspect. Target has grown earnings over the same time frame at about 7.36%. Very similar. Again, that's measuring it from this point to this point. Okay, so Target and Walmart both look very similar when it comes to operating earnings growth. All right, now when we go into forecasting, there is going to be a difference. Target is only forecast to grow at about 6.25%. I'm going to take price off of the graph for a minute. When we go to Walmart and look at their forecast, Walmart's forecast to grow at about 9.76%. So we've got almost a third higher forecast growth rate on operating earnings compared to Target. Okay, so Walmart advantage Walmart here. But now let's go back to the historical graphs of both companies, and let's put weekly closing stock prices on the graph. And there's a couple things I want you to note. First of all, you'll note that the stock price correlates with the orange line, the earnings justified valuation reference line. And even when you see Target had this huge uptick in earnings here in 2020 and 2021, we saw the price follow that. And then they had a correction and the stock price, of course, fell and dropped precipitously. This idea of understanding where the price is in relation to the fundamentals is critically important. But now if you look at this, you can argue that what's happening here is that we're going back to trendline earnings growth here. Okay, in other words, earnings for 2025, 26, and 27 puts us back on trend lines. Let me do that again. If I go to what the trend line number here, and this was an anomaly earnings, but now we're going back and it's going on its same trend line that it's been on. But here's the point. If you look at Target's stock price relative to the earnings, Target is trading at a discount. It's trading below the orange line. It's offering us an earnings yield of 8.5%. It's trading at a blended PE of 11.75. Now, by the way, this is based on operating earnings. I get this question a lot, so I'm going to go ahead and bring it. If I go into diluted earnings, which is GAAP, adjusted operating or not GAAP, we still see a very similar PE on target, but we do see some differences where there's some non-recurring charges and other accounting adjustments that are included in GAAP. Okay, so we're looking at adjusted operating earnings because adjusted operating earnings give you the opportunity to really look at how the company's performing on an operating basis, and it's excluding one-time charges and other accounting conventions. All right, but there's two metrics that I personally like to use when I'm evaluating companies, especially when I'm comparing two companies like this. The next one is EBITDA, which is also a good way to look at how the operating of results of the company is doing. EBITDA is earnings before interest, taxes, depreciation, and amortization. So what EBITDA does is it basically uses it to evaluate a business's operational performance because it provides a clearer picture of a company's profitability because it's focusing on earnings generated from core operations, excluding the effects of financing and accounting. Now, when I look at target based on EBITDA here, I see that just like we saw with operating earnings, the price is trading at a discount to its earnings justified valuation line, which is the orange line. Now let's put that same exercise and let's do it with Walmart. So let's add weekly closing prices first of all. And again, we see this normal, strong correlation between operating earnings and the company's stock price. And then we see Walmart getting a very high valuation starting in 2017. And by the way, it has a January fiscal year. But then all of a sudden we have this astronomical value. Now, I'm asked to pose a question. Walmart has grown earnings at 6.3%, and it currently trades at 33 times earnings, and it has an earnings yield of under 3%. Target, in contrast, grew earnings. Let me move back to earnings. Target, in contrast, grew earnings at over 7%. Okay, so more growth than what we saw in Walmart, but it only trades at 11 times earnings with an 8.5% earnings yield. So what's really the difference? Why is Walmart being valued so much higher than Target? And the question is because the market often misappraises common stocks, and it runs these stocks. I've shown examples like with PayPal, and I've got a whole portfolio of what I call hammered tech, where tech stocks were trading at these astronomical values, and then all of a sudden eventually reverted to the mean and came back into reality. So Walmart is a great company, by the way, AA rated with 34% debt to capital, in contrast to Target, which is A-rated with about 50%. So you could argue that Walmart would be a slightly higher quality company. But again, that doesn't indicate that you should be paying almost triple the value. And we can see Walmart's already starting to show a correction here where the valuation has simply gotten way out of line with anything that would resemble intrinsic value. Okay, now the other metrics I like to look at, like I said a minute ago, is I like to look at EBITDA, and for the reasons I already expressed. EBITDA really is another way to look at the value of a company. And if I look at Walmart based on EBITDA, we see that it's traded at around 8.5, 8.4 times EBITDA, more or less, very consistently. And you can see when it was trading below that, these were great times to buy the stock. And it was trading above that, it was still a great time to buy the stock unless this massive correction comes out. But if you're a new investor coming and looking at, you want to buy a retailer, and Walmart and Target are literally the kings. You've got Amazon and Costco in there and companies like that. But for the everyday retail, you got Walmart and Target here, and both of them are very popular. And you see this crazy, but you'd have to invest in Walmart at this very high valuation. And yet you could buy Target with very similar fundamentals at a much lower valuation. Now let's go into EBITDA on both of them. So I've already showed you EBITDA on Target, and Target's EBITDA growth has been about 6%. So let's look at Walmart's EBITDA growth, which again is a real good measurement of profitability. So Walmart's EBITDA growth has been about 6%. So we got Target growing EBITDA at 5.91%, and we've got Walmart growing EBITDA at 6.2. That's the same number, 5.9, 6.2. There's always going to be these variations. The point is they have similar fundamental economic growth. Okay, so let's look at some other things now. Let's go into fiscal fitness here on Fast Graphs, and let's look at the all-important margins, okay? And let's do that for both companies. We'll go into fiscal fitness, and then go into margins, because margin is what it's really about. When you're looking at things like EBITDA and operating earnings or even sales, it's how much margin can they generate on those income models that we're talking about. So let's start with Target. Gross margin through the period ending January 25 was 25.8%. We go to Target, gross margin was 24.85%. Virtually identical, not exactly identical, but virtually identical. If we look at operating margin, we have 4.31% for Walmart, and we go to Target and we look at operating margin, and we have 5.22, a little better, but again, essentially the same. Target's net margin was 3.84%. If we go into Walmart's net margin, it was 2.85%. So again, these companies operate fundamentally very, very close to each other. Okay, now we can also look at some other things. For example, share buybacks. You'll notice that Walmart was buying back shares starting really in 2010 through and even into 2019 or 20. If I look at their historical value and I look at 2010 through 2017 or 18, they were buying stock back when the price was below its intrinsic value. I think that's a real good use of capital. I wouldn't want to see Walmart buying stock back today, and in truth and in fact, they're not buying stock back today. Okay, if you look at the last 3 or 4 years, they've kept their share count virtually identical. Now, going into Target and looking at share buybacks, Target has been consistently buying back their stock. But again, if I look at the historical graph, it's consistently been inexpensive except for this brief period just post-COVID where it rallied. And it rallied on pretty strong growth, 30% and 29% growth, but that gets people excited and they push it up to an extreme, and it wasn't long before it corrected back to fair value, kind of stayed in that range for a while, and then it corrected back to fair value again, and now we can buy Target at an undervalued. So let's look at forecasting. Let's look at EBITDA forecasting for Target. Only expected to grow at 2.5%, but you can buy it at such a low valuation that if I go out here, if they only grow earnings by the 2.5%, and they generate $19.94 of earnings by January 2028, and the stock trades at a fair value ratio of 7 times EBITDA, that's the orange line, it's only 7 times EBITDA, then you could make 14% on your money. If you look at the normal multiple of EBITDA for Target, it's about 8.61. You could make 21 or 22% annualized on your investment by buying it now if it traded at an 8.6% EBITDA. Now, looking at the historical graph, we're looking at a 7 times EBITDA number here. That's what the orange line is on this graph. It's 7 times EBITDA. Anywhere I point to the orange line, it's 7.04 times EBITDA. So a 7 EBITDA would be a pretty reasonable number. When I'm looking at the forecasting here, okay, if I'm looking at the normal price to EBITDA, I'm looking at the last 5 years, it's been 8.61. But if I hit this drop down, I can see that the number has hovered around 7 quite a bit. So I like to be conservative when I'm evaluating things. I can even put in here like a 6 point, the lowest one I can find is 6.72 times EBITDA, and I still would have an opportunity to make over 12%, almost 13% on my money. Now let's run Walmart through that similar exercise. Okay, so first of all, let's go into, we got EBITDA here. So we got EBITDA expected to grow at 8.4%, and the fair value ratio would be 8.41. So if it were to trade at that multiple out here at the end of 2028, just like we did with Target, you'd actually lose 11% on your money. You'd have a negative 11% a year because stock would revert to the mean, where Target was reverting to the mean up, Walmart would be reverting to the mean down. If you applied then the normal multiple like we did with Target, Target's normal multiple for the last 5 years has been 10.8. But looking at it historically, 9 has been and 8 have been a very common multiple. But if we did the 10.8, which is very aggressive, if you will, we would still lose over 4% annualized. We turned $10,000 into $8,857, including expected dividends. All right, so in other words, we would lose money buying Walmart now if it returns to the norm, as it will, where in the case of Target, we would make money if it traded at the norm. Okay, and we can, and by the way, these forecasting graphs are calculators. You can look at these at what would happen at different, what if it traded at a 10 multiple? If Target would trade at a 10 multiple, you can make 28% a year on your money. If we look at Walmart and it traded at a, well, we got it at a 10 multiple, you would lose money. If it traded at a 16 multiple, which is, by the way, not unlikely, I mean, that would be reasonable. Let's do 15. You'd make 7% a year. Okay, so you could make money with this company's growth. So the bottom line is you've got much better valuation in Target. And I'm going to repose the questions again. I'm going to go back and I'm going to use EBITDA, and I'm going to go to the historical graph. With both companies, with Walmart growing EBITDA at 6.2% and Target growing EBITDA at 5.9%, how do you justify being able to buy Target at a blended price to EBITDA of under 6, where if you go to Target, you got to pay a blended EBITDA of 16. It's 2.5 to 3 times higher price. As Warren Buffett has so aptly said, price is what you pay, value is what you get. Okay, so we got two retailers, two similar fundamentals. We just got two different market values. And by the way, when you look at Target, when Target got crazy overvalued, where the price to EBITDA was over 12, let's look at it from earnings. Let's summarize this and end this both with looking at earnings, because that's what you see reported in the papers and the websites most often. So let's do both of them in earnings and finish out. I like to look at EBITDA and I like to look at earnings as valuation references. All right, so you've got Target here trading at a PE of 33.5, and it got as high as a PE of 37.7 times earnings. And of course, that means earnings yields are under 3%. Where I look at Target back here did get up to only a 20 multiple, 20 times earnings, and yet we saw this huge collapse. But I want you to understand this collapse was a function of earnings turning down and the stock being overvalued and being vulnerable. In the case of Walmart, we're seeing what might be the beginnings of the stock reverting to the mean and coming back all the way to fair value. And there are lots of examples of stocks that are doing that right now, and that might even be a good video that I could do in the future. So the bottom line is Walmart would be one to sell, Target would be one to buy if you're looking to add a retailer to your portfolio. Now, because Target is so cheap, I also want to point out they have a 4.29% dividend yield currently. And if you look at their dividend growth over time, they've grown their dividend by about 14, almost over 14% average growth and compound growth. When I look at Walmart today, Walmart has a dividend yield of only 1.1%. And from a standpoint of how fast they've grown their dividend at about 8%. All right, so we have faster dividend growth with Target historically, perhaps not as fast going forward, but the bottom line is we're looking at a yield advantage of buying Target today with a 4.29% yield advantage. Well, it's almost 4 times, more than 3 times the yield that we can get with Walmart right now because of the high valuation. Both excellent companies. It is not enough to just discern how good the company is. It's also critically important to recognize how the market is valuing it. Because one of the things I like to say, when you see a company like Walmart trading at these high valuations, you have other people appreciating Walmart much more than I do. If I owned Walmart, I'd be considering selling all or some of it here. If I owned Target, I'd be considering buying more of Target here, or even adding to Target today. Anyway, this has been Chuck Carnevale bringing up using two really similar stocks to show and illustrate the importance of valuation. I just can't stress it enough. So many people look at the market and they don't really think about how valuation comes into play. A business is worth the amount of cash that it's capable of generating for its stakeholders. FastGraphs uses a modified form of discounted cash flow to analyze the intrinsic value of the business and measure whether the stock price is trading at that or not. If you like this video, give it a like, subscribe to our YouTube channel, and take a look at subscribing to FastGraphs as well. It's the value investor's best friend, in my opinion. Thanks for watching, and talk to you again real soon.